Well, we are barely into 2022, and we are seeing a lot of stock market volatility this year, and other investments like crypto and bonds and things like that are also volatile and kind of uncertain. So what do you do if you want to protect, especially your retirement, from some of these extreme movements in investments? And with me is Ty Young, the CEO of Ty J. Young Wealth Management. Ty, welcome. First of all, great to
Thank you.
talk to you.
Thank you for having me.
So let's just start with kind of like an umbrella look. You were telling me a little bit about the important components of a retirement plan. So what should everybody have? And then we'll dig into some of the different options.
Great question. So a winning retirement plan or investment plan, depending upon where you are on the working to retirement continuum, three things, three elements. First, income. You've got to be set up for income either now or in the future. Second, you've got to be set up for growth to support that income or to grow the portfolio. And third, the third element is protection. And almost everybody or a lot of people miss that component. Protection against the black swan event, the crash or the correction in the market that based on history we know is going to come. You've got to have those elements to have a winning retirement strategy.
So let's talk about each one of those a little bit. So the income, so that would be, so I could still pay bills. When I'm retired, I can pay my health insurance and my grocery bill, and so that's part of it. What is a good investment fund for the income?
Well, the income, it comes from the portfolio. Dividend stocks are a great place to get income from. Payouts on annuities are a great place to get income from. If you have bonds are a good place to get income from. In this environment, you got to have growth. So you can, and when we've had crazy growth over the last several years, a lot of people will start to sell some of their shares of stock to get income there. So it comes from lots of different sources, and it's important to take income out in a balanced way to maximize that income and to minimize taxes as you do it.
And then the growth element too is important because, as we know, we are in an inflationary environment, unlike what many people have seen in their careers. So you need that growth to stay ahead of inflation.
You absolutely do. We have more inflation right now than we've had since 1982, like 40 years since we've had this level. So I think 7%, more than 7% was the inflation rate, 7.6 I think it came in at. Well, a CD is paying 1. So if you're in a CD, you're not keeping up with inflation. You've got to have investments that are growing at the rate of inflation or greater. Stocks, many of those have grown in the last year far greater than the level of inflation, and other ones too. So having investments that are not only growing and protection is important too. I guess we'll talk about that in just a second, but you have to have the growth element to keep up with inflation and provide that income that we talked about.
So, and protection. So we've been, so I think back to March of 2020, stock market down 3,000 points in a day. 2008, 2009, huge drops in the market. We came back, and actually, within a year or so, but a lot of that felt like it was from government help. I think we didn't have so much government help that, would take a lot longer. And if you're close to retirement, you don't have a lot of time to wait. So the protection part of it is also important. You want to make sure you protect that money you put away.
That's right. You make a great point. In 1929, when the market crashed, the government didn't get involved, and it was 10 years before it came back. Now we have the Federal Reserve printing $1 trillion a year, literally out of thin air, and buying bonds to support the market and bring it back. And that's largely what the market is trading on in here. But with that kind of volatility, especially if you're in retirement that you described, can be mitigated. There's products that we use, guaranteed insurance contracts, probably the most popular ones, one called a fixed index annuity. And the way that one works is, and this is for the protection component of the portfolio. The way that one works is you put your money in, the best ones don't have any fees, and your money is completely protected against market losses. And when the stock market goes up, you go up with it. Your gains lock in on an annual basis. And when the stock market goes down, you don't lose anything. You do receive compound interest, and the best accounts don't have any fees. So you get the growth, historically about 6 to 8% that you really, really want. And you get the protection component that most people really need. It's not something for all your money, but as part of an intelligent winning portfolio, it's very, very important to have that protection, and that index annuity does that for you.
Okay, interesting. Because I don't know a lot about the index annuities, but that sounds like something worth looking into. So
Without a
sure.
doubt.
And and like I mentioned, the government has come in and helped during a couple of crises, but I mean, they can't do that forever. And I mean, of course, the pandemic, it made sense. I mean, they were shutting everything down, but what if we just have a good old fashioned economic sell off based on inflation or something? I mean, the government, and part of the reason why we're seeing inflation is because of the government spending. So they can't really come in. So we may find ourselves in a little bit more of a pickle here, so to speak.
Without a doubt. I mean, as to your point, we're printing trillion or over $1 trillion a year out of thin air. We're loaning it to ourselves in the form of bonds. That's not a sustainable strategy, to your point. So we get a real sell-off. How much more money can we borrow? How much more can we print out of thin air without causing even more inflation? So protection is huge.
Yeah. Okay. Well, thank you so much, Ty, for coming, and thank you for your advice.
Thank you for having me. I appreciate it.